Hi class, and welcome to the second video of Unit 3 Accounting, which is going to be an introduction to balance sheets. If you're following along in the textbook, it is in Chapter 2, and for many of you that have done Units 1 and 2 Accounting, this video is a refresher or revision. What are we going to cover in this video? The learning intentions are that I hope by the end of this video that you can explain the purpose of a balance sheet. I hope that you can define the accounting elements, or at least they've come back to you if it's been a while since you've looked at the accounting elements. Remember, they are assets, liabilities, owner's equity, and revenue and expenses. We're only focusing on the first three today. You can classify assets and liabilities as current or non-current, and using all that information, you understand how to create what we call a classified balance sheet. And more importantly, in this video, we will complete a classified balance sheet to practice and show all the required skills in this introductory balance sheet video. So firstly, what is a balance sheet? A balance sheet is a financial statement that we use to report the financial position of a business. So we're looking at the financial position, and it occurs at a particular point in time. What we are specifically showing is three elements of our business. It is going to show all of the assets under the control of the business, all of the liabilities, remembering our liabilities are obligations or potentially simplistically something that we potentially owe to someone else. And then the owner's equity, remembering owner's equity is all of our worth of the business to our business owner, which is our assets minus liabilities. Now, these three elements make up the most important equation in accounting, our accounting equation: assets equals liabilities plus owner's equity. All of our assets equals, we've got our assets through either liabilities or it has increased our business worth. That's why the balance sheet is so important. It covers three elements, and it's incredibly important to investigate the financial health of a business. What are our assets? Really quickly, to tick off that second learning intention, these are our economic resources controlled by an entity as a result of a past event. So we control a resource, and this resource has the potential to produce future economic benefit. So key words are: it is controlled, it occurred in the past, and most importantly, it's going to give a future economic benefit. Liabilities are present obligations owed by an entity. So we have an obligation to transfer an economic resource. We have to transfer something that is beneficial to us as a result of a past event. This then results in our residual value, owner's equity, our assets minus liabilities. So what is a balance sheet? It looks like this. It shows all of our assets, liabilities, and owner's equity for a particular point in time. So what do you notice about this balance sheet, and can you rewrite this accounting equation? Have a think, have a look at this, maybe even pause the video. So this video is for the 30th of June for a business called City Cycles. What do we notice? It is showing our accounting equation. Our assets are $150,000. And all of our assets are listed on the left-hand side of our report. And then our liabilities plus our owner's equity also equals our $150,000, because our assets equals our liabilities plus owner's equity. Our liabilities here are $45,000, and our owner's equity is our capital of $105,000. And if you look at it closely, we are listing all of these items individually: cash, accounts receivable, inventory, office equipment, vehicles. And for many of us that have done Unit 1 and 2 accounting, we are hopefully familiar with this. If you're not, this is a good time to pause it, make your glossaries, ask questions of your teachers. They'll be able to help you with those terms. So how do we show the format really quickly? There really is two potential formats, but one is much more common in Units 3 and 4 accounting. We might do a T-form balance sheet, which is presented horizontally, just like the one that you've seen there. This is by far and away the most common presentation, but we might also provide you with a narrative report, which looks a little bit different, like so. There's not the assets on the left, the liabilities on the right, and owner's equity on the right. It is prepared what we call vertically, up and down. And however, if we look at these, you can see my question to you is, does the financial information change? No. In my T form that you're most likely going to see, we have $150,000 of assets. Our liabilities known as equity equal $150,000 because we have $45,000 of liabilities, $105,000 of owner's equity. Nothing has changed in our other form, but we just list it vertically. Our assets are listed first for $150,000. We then list our liabilities of $45,000, and then our owner's equity of $105,000, which equals $150,000. And if you look at the items within it, they're all exactly the same. So you might be shown a narrative report occasionally, potentially to try and trick you, because they could, but the information is always the same. And 99 times out of 100, you're going to be asked to make this form. And that's the one we're going to make in a second. So now's the time to start to practice. Let's create a balance sheet. I'm going to give you some information. This is a class slide, so I would get my class to work in pairs, but in a video, work through it. Can you create a balance sheet in T form given this information? This is a business that has a 7 assets, liabilities, and owner's equity. Can you use this information to make a balance sheet? And the first question I have to you is, what do you need to do first? I want you to think about that. What do you think you need to do with this information to make a balance sheet? Now, if it was my class, I would say the first thing you need to do is what we call classify these. Work out whether these are assets, liabilities, or owner's equity. So this is the task for you to do. Pause the video. But if you want to go through it with me, we would know that our cash is an asset. Our loans are a liability because that's an obligation to pay the bank back. Inventory is something that we are going to sell, and it is an asset. It is something that we control. It's a resource. It will give us future economic benefit, sales. Accounts receivable. Customers who bought goods and services, goods from us, but haven't paid us back, but they have to. That is an asset for us. Our capital is the business worth, owner's equity. In this case, Mr. Ham, me, this business to me is worth $12,000. And accounts payable is a liability. I owe my suppliers $2,500. GST clearing here is a difficult one. I'm just going to give you the answer because you're seeing something that you've probably never seen before. What the hell is this DR? That means it's a debit. We will learn in the future that this for GST clearing means it is an asset. The customer, the tax office owes us cash. Now, once we've done that, we can just put this information into our balance sheet. And I've created one here for you. So let's remember this really quickly. Cash is an asset. Loans are a liability. Inventory is an asset. accounts receivable is an asset, capital is owner's equity, GST clearing we know is an asset now, and accounts payable is a liability. I can then use this information to create my balance sheet. So let's do this really quickly. We're just going to find all of our assets and write in the headings. Cash at bank, inventory. I'm going to do some shorthands for the sake of the video. Accounts receivable and GST clearing. Now there is some logic behind which one goes first, but let's not worry about it too much. What do we then do? We put all of the totals in. And what there probably should be here is $2 signs. And we know from units 1 and 2, if we have to add up more than one number to get our total, we put the individual totals on the first dollar sign on the left column. So $15,000 of cash, inventory of $3,000, accounts receivable of $13,000, GST clearing of $1,500. I add these up. This equals my total assets of $32,500, and I probably should put this down here. $32,500 of assets. I know that my equities must also equal, so we'll put our dollar signs here, which is my liabilities and owner's equity, must also now equal 32,500 to be accurate. Why? Because my assets equals liabilities plus owner's equity. Let's put our information in. We have a loan, so we have accounts payable. Accounts payable, apologies, I'll write that one in correctly because it's a bit unclear, of $2,500. And I have a loan of $18,000, so a big loan, presumably to the bank. I add those up, that equals to $20,500. And my owner's equity is my capital, Mr. Ham, of $12,000. I don't need to put it in the left-hand column because there's only one. 20,500 plus 12,000 equals 32,500. I have created a balance sheet. Well done. I've classified my information and my balance sheet balances. So I'm pretty confident. What does this mean? My business has $32,500 of assets. I can tell that from here. And this is comprised of a number of assets. 1, 2, 3, 4. And I have $20,500 of liabilities, mainly a loan. And that means I have $12,000 of owner's equity. My business is really worth $12,000 to me. And that's the power of a balance sheet. I can do some analysis. And if your question doesn't ask you to, I always encourage you to pause and go, is this business doing well? The power of an accountant is you can look at this information and understand it, and you can start to give some advice. Are we happy? How can the business improve even if it is going well? But well done if you have followed that. We then come to this concept of classification. You might have heard of that. We've done that in units 1 and 2 accounting. That balance sheet seems a bit simple because it is. So some questions. What do we mean when we hear the word classification, classifying, or maybe more importantly, classified if you're asked to make a classified balance sheet? I'm literally meaning putting something, our assets, liabilities, or owner's equity, our assets and liabilities predominantly, into specific groups or categories. So why would a business want to put these assets and liabilities into separate groups? Because it provides more information. I can do better analysis and give better advice. So how do we classify our assets? we classify them according to what we call liquidity. And that is how quickly these can be used up or turned into cash. How are liabilities classified? How urgently they need to be repaid. So that's all we're doing when you see the word classified balance sheet, which in units 3 and 4 accounting, you almost always will from now on. We're just putting our assets and liabilities into more categories to give better information. So what are our categories? You might remember them. We are talking about current assets, current liabilities, non-current assets, and non-current liabilities. Current assets are assets that are expected to provide economic benefit within 12 months. You're going to turn these assets to cash within 12 months, and that's the key. Will they be turned into cash? And this largely includes cash, because it's already cash. Inventory, you're going to sell your goods within 12 months. Accounts receivable. Customers who you have given goods to and they haven't paid you back yet, you really want them to pay the money back within 12 months. You expect that to happen. Non-current assets, on the other hand, are assets, so economic resources, that you're going to hold for more than 12 months. And these include things like vehicles, computers, shop fittings, equipment, and many others. And we'll be exposed to lots of them in units 3 and 4 accounting, and we'll add a bit of complexity there throughout the year. Current liabilities, though, are obligations that we need to pay off. The key term is settled within 12 months. You must meet your obligation within 12 months. These include bank overdrafts and loan repayments that are due within 12 months. And also accounts payable, so suppliers that you owe money to, because they're going to expect their money back as well, just like we expect our customers to pay us back. Non-current liabilities are all of our liabilities that are expected to be settled longer than 12 months. So this is all of our long-term loans that don't need to be paid within the next 12 months. So now's the time to think. This is where it might start to get a bit complicated. How would you classify a loan that is for $10,000 but $2,000 is to be repaid each year for 5 years? So you have a $10,000 loan, of which each year $2,000 must be repaid. So how am I going to, in my balance sheet, now that I know that it needs to be categorized with current and non-current, how will I do that? Have a think. Simply, I'm going to do a bit of a shorthand. We know we have current liabilities and non-current liabilities. How much of this loan needs to be repaid within 12 months? Clearly, just $2,000. So $2,000 is current, and that means $8,000 is non-current. The next year, $6,000 will be non-current, and there will still be $2,000 due within that year. And that's how we start to think about our loans, and you'll be exposed to that a lot. And here are two others that are questions. How would you classify these types? Have a think. Maybe pause the video. We won't go through these today. Because what we are going to do is add some complexity to our example that we just did. You can see here that we have the same information. Cash, inventory, accounts receivable, all of the same information, although I think I've called this business, Miss Fraser's business, capital. So it's like the same business, but business owner is slightly different. And you can see here, unfortunately, I've changed it back to Mr. Ham, so we'll keep going with Mr. Ham. But the key difference here is I've given some more information. Always in accounting, if you're given information, it's highly likely that you're going to need to use it. So let's go through the easy bit. Let's quickly classify them. But now we have some more information. Are these current assets or current liabilities? Inventory is held for resale. That means we're just going to sell it really quickly. The purpose is to sell it. It's implied in the name, and we know that you expect to sell your inventory within 12 months, might go off, so we have a current asset. Our cash at bank is already cash, so it's also a current asset. A weird one here, which you're unlikely to see, but you can see that 10% of accounts receivable is not due for 18 months. So the accounts receivable is now going to be split up as current assets and non-current assets, because 10% of this, $1,300, will not be turned into cash within the 12 months. The remainder, $10,700, is going to be paid within the 12 months. Accounts receivable almost always a current asset, but here, let's just remember we have a little bit to add there. Owner's equity, we don't mind. GST, we expect our government to pay us back within the 12 months, and our suppliers expect us to pay us back within 12 months. So now we can add a bit more information to this, and we will list our assets and our loans, liabilities, in the order that we expect them to be turned into cash or paid for cash. And that's why we're always recording our cash at first. So let's now go ahead, and we'll be doing this pretty quickly because you'll be practicing it in class. Our cash at bank is a current asset, and it is $15,000. Our inventory is also a current asset, and it is $3,000. But now here it becomes slightly different. Our accounts receivable is not 13,000. It is, and sorry, apologies, it shouldn't be 10,000. It should be 11,300. Is 11,700. And our GST clearing is $1,500. So if I add those up, it's not totaling 32,500. I'm going to take 1,300 from that, because it's non-current assets, and that means it is $31,200. Because I here, in a weird one, have accounts receivable of $1,300 that are non-current. So my total assets are still $32,500, but you can see I've split it up. $1,300 of these assets is not going to be turned into cash within 12 months. Now this is a simple example. There's heaps of other non-current assets. Vehicles, computers, shop fittings, equipment, vans, land, buildings. It's important to split this up. We then have our loans, which we need to think about. Our loan, $8,000 is due within 12 months. The rest is not. That means we have a loan of $8,000 due within the 12 months, and all of our accounts payable due within the 12 months. So that equals $10,500. We now have the remainder of that loan as non-current, $18,000 minus $8,000, so $10,000. And apologies, I should have put that on that side as non-current. Our capital remains $12,000. And if we add all of this up, our total equity is $32,500. So this is still relatively roughly done that I've done it, and it's new for many of us, but you can see I've shown the same information, but because we have more information and classified it, I'm telling the world more information. I can analyze this better. I have lots of current assets. So all of my assets are likely going to be turned into cash pretty quickly. A good thing, likely. And not as many of my liabilities are current that need to be paid back within this 12 months. Because I have a loan that's going to be paid off that's due after the 12 months. So this might mean I have a bit of extra cash floating around that I might invest in my business to build my capital in the future. But I need to be always planning to make sure that I can pay off my non-current liability loan that is due in the future. Now, this is some quite in-depth, high-level accounting for our second video, but this is the power of a classified balance sheet. And with that, I hope, and it's been a relatively long video, not all of them will be this long, that I hope that you have achieved all of our learning intentions. Let's look at, I hope you join me for our next video where we go through how ongoing transactions impact our balance sheet.